I recently did this video on the RSP ETF, Invesco's Equal Weight S&P 500 ETF, and the premium or anomaly associated with equal weighting. And I got someone in the comments asking what I thought about the GSEW ETF. Now that is Goldman Sachs Equal Weighted Large Cap Fund. So I figured I would take a look at that. Now, before we take a look at that, in case you're not already familiar with it or you haven't caught this video here, I'm just going to touch on some of the basics of equal weighting. First, equal weighting has shown to outperform market cap weighting, at least in the S&P 500. I shouldn't say at least in the S&P 500. It has outperformed in other markets as well. And if we can pull up the chart here. Okay, so the chart has loaded, and if we look at it, we can see the total return of $10,000 invested in the S&P 500 equal weight being the purple line, and this orange line being the S&P 500 market cap weighted. Again, this is on a total return basis, so that assumes that it's reinvesting all dividends and capital gains back into the fund. In $10,000 invested back in 1976, invested in the S&P 500 market cap weighted would have grown to about $1.4 million today. Versus the equal weight would have grown to almost $3 million. So it is a fucking huge difference, huge outperformance by simply equal weighting. And there has been some data, and I'll link to a document that shows the outperformance across other indexes of equal weighting. So basically what I'm saying is equal weighting has, oddly enough, shown to outperform in other indexes and markets. And it really outperforms on large cap indexes, not so much with small cap indexes. I wish I would have had that document open. I do cover it here in this video, and I'll link to it below. Now, what causes this equal weight premium? Is it alpha or is it an anomaly? And quite frankly, well, like with many things investing, no one knows for sure. This rolling 5-year regression analysis here, and I think this is by Northern Trust, shows that it has a high coefficient to SMB, which is small minus big, so the size factor, and a low coefficient consistently to momentum. So possibly it benefits from the size factor, hypothetically, or theoretically, and could also benefit from a lack of momentum. One thing that I've kind of observed here is there's definitely some type of, because it rebalances, right? So it changes up the sector exposure. And although I don't explicitly say in this video, I do look more at the sector exposure in this video. But fundamentally what happens in market cap weighting is sectors kind of bubble. Like in 2000s, the tech sector bubbled. Right now we're seeing a really high valuation in tech. We don't know if it's a bubble yet. Sure seems to be with the way the NASDAQ has performed over the last 6 months. But anyways, in the equal weighting rebalancing process, it seems to, in my opinion, benefit from avoiding the high valuations of specific sectors. So maybe there's some type of like value sector anomaly going on there, and it's consistently capturing that. That's, again, just my opinion. No one knows for sure, but looking at the data here, and this Y chart takes forever to load when you leave the browser tab, there's definitely some outperformance in equal weighting. So yes, that is why there's so much interest in equal weighting. Now, more specifically here, let's go to the GSEW ETF. First thing that I wanted to know is, how many holdings does it have? So which index is it tracking, and what is the expense ratio? Right in the title, we can see it's large cap. Okay, so this is reminiscing me, or kind of premonitioning me. I don't even know what the word would be here, but it's making me think S&P 500. And then down here, we can see correspond to the performance of the Solactive US Large Cap Equal Weight Index. Okay, what the hell is the Solactive Large Cap Equal Weight Index? Rather than looking that up, what I just went to do was went over to Morningstar, and I wanted to look at the portfolio. Let's just see how many holdings this portfolio has. And when it loads, TikTok Morningstar. My computer also slows down when I'm using the screen recording software, and I've got 1,000 browser tabs open. You can't see it because I don't have them open in this window, but I do. So equity holdings of GSW is 501, okay? That's telling me that this is basically an S&P 500. And why aren't they tracking the S&P 500? Well, most likely there's licensing issues with tracking the S&P 500 index, so they basically created their own index for GSEW. They created their own index, which was as close to the S&P 500 index as they could make it without violating the licensing rights of S&P Global. So I would consider this basically an S&P 500, equal weight. Then there's some other details here which I wanted to point out. Number one was the expense ratio. So let's see if we can find that. The expense ratio on this was, I know it's a little bit cheaper than RSP in terms of expense ratio. Expense ratio is 0.9%. The equal weight by RSP is 0.2%. So this is, relatively speaking, half the cost, or GSW is half the cost of RSP. That's a nice perk on it. And then down here we see systematic rebalancing. So RSP rebalances quarterly. This one says monthly index rebalancing enables the fund to adjust to market movements and better maintain its equal weighting. So this thing is rebalancing monthly, whereas RSP is rebalancing quarterly. So that's going to make a little bit of a performance difference. Let's put them on a chart together here and look at the performance. Okay, so RSP being the red line, GSEW is the blue line, and it looks like GSEW has had a slight outperformance, and then just recently in the last month it kind of underperformed. But basically, they're really doing about the same. If we set this to daily, I bet you'll see more volatility with RSP. And yeah, it kind of looks like that. GSEW is benefiting from that kind of quarterly, I don't want to say benefiting, but they're performing a little differently from that monthly rebalancing. So they're capturing, I think they're capturing, when things dip, they're kind of capturing a faster rebound, maybe. But you can see there's a little performance difference here, but broadly speaking, right, even though it looks like GSEW is outperforming, RSP, based on this time horizon, is the one that outperformed. But I would say that really doesn't matter. Let's go back to, here, and we can see what their AUM is. Where's AUM on this thing? That's what I was going to go for. I'm not seeing AUM. Ah, there it is. Net assets, $868 million. That's, I don't want to say it's relatively small, but that's kind of small. It's not like extremely small. There are ETFs out there that are like $7 million. The equal weight S&P 500 by RSP is $32.1 billion. Now, here's where that makes things interesting. The spread, okay, the difference between the bid and the ask on RSP is 0.35%. On the GSW by Goldman, if we come back to Morningstar, I'm guessing that spread is going to be a lot higher. All right, yeah, the spread a lot higher, 11.32%. So that's a big spread. So fundamentally, ETFs are a lot safer to trade when there is these big spreads like this than, say, a stock. But still, it can cause problems. When you have a high spread like this really lends itself to, I don't even know what to call it, but like middleman taking their part out of it. Like, for example, if you use, say, Robinhood is known for this. They kind of charge a buried fee in there, on the bid and ask. They charge a spread fee. They don't explicitly say it, but it's well known. That's how they make their money. They execute, the price that they sell to you is a little bit different than what they're buying it for, right? So they're not charging you the raw transaction fee. I would be very hesitant to utilize this in like a Robinhood account. In fact, the only broker I would really do this with would be Interactive Brokers, because I know that they do not do it. And I think there's also Public.com app. Huge plug for Public.com, a new app that recently started. They don't do any middleman kind of spread trading there, right? So yeah, you have to be careful with the broker you trade this at. The other thing too is if you're placing orders for this, you're going to want to use limit orders to really control it. But personally speaking, I would not use GSEW. Okay, so I guess we'll kind of get into my thoughts here in the summary on this. I don't see a benefit to this GSEW ETF other than its expense ratio. I don't think that the monthly rebalancing really matters. Monthly or quarterly, in the end, it's all going to work out about the same. GSEW does have the benefit of a lower expense ratio, but that's certainly because they've got low assets under management, right? So they're trying to undercut RSP and appeal on that expense ratio side. But then you've got this bid and ask spread. It's not a huge deal if you're a buy and hold investor. You're probably going to take a little bit of a haircut when you buy in and a little bit of a haircut when you sell. You can control that using limit orders. But that said, I don't like to use limit orders and wait, all day for my transaction to happen. I do use limit orders unless it's a really highly liquid ETF where the bid and ask spread is like 0.01%, like the S&P 500, like SPY or something. So in that case, I just do a market order. But I do use limit orders, but I won't like to see my orders complete really quickly. So I'll refresh it, wait 30 seconds, refresh it, and wait to see my order complete. I would not want to have to leave the order pending all day. I like to see them complete and get the market price or close to the market price when I transact. Yeah, so for that reason, I personally would not use the GSW ETF. Now that's just, my thought and my opinion on it. Again, just to summarize it and reiterate before I sign off, I don't really see any premium associated with that monthly rebalancing that GSEW brings to the table. Yes, it does have that lower expense ratio, but based on my own personal use and the way I like to trade and execute my trades, I would not use GSEW. I would just use RSP simply for the fact that it is more liquid and there's substantially more trading volume going on. So that is my look into RSP and GSEW. If you notice anything that you think I left out, certainly let me know in the comments below. I'm signing off on this one, guys.